That's a nice looking beard.
Hey, thanks. My wife doesn't like that either, but
Really?
no, she's tolerating it this year. I don't know why. I just told her I just don't have time to shave. I've got to cut off every minute I can in the morning. I've been so busy lately. My wife doesn't like that either.
Are you still doing the Gertrude protocol?
Yeah, good memory. Yeah, I am. I sure am. In fact, you'll probably see me down a couple juices during during the webinar.
Okay, cool.
Yeah. So I want to share my screen, not just my camera. So you ready? You ready for me to try that?
Yeah, go for it.
Yeah, absolutely.
All right. So don't judge me for this. All right. So you're seeing the screen?
Yep.
All right. Now I'm going to actually start the presentation. And tell me if you see tell me if you see that slide, PowerPoint slide.
Yep, that's perfect.
All right, great. All right. Yeah, so Tim's scrambling. He's got to cover $250,000 in short-term gain if we close on this mobile home park this Friday, which we're supposed to. Like, he and I co-own it. Well, we're going to co-own it for like 5 minutes.
Oh, is it a flip deal?
Yeah.
Gotcha.
Yeah, sure is.
Let's see.
Just getting the live stream stuff set up.
Okay, great.
That's pretty cool. So that flip deal, where was that one? Was that on the southeast, or where was that mobile home park?
Fairbanks, Alaska.
Oh, that's right. Yeah, I think you were telling me about that one a little bit.
Yeah, it's a crazy deal. It's might be a once in a lifetime thing for me. I think it will be, at least. And Tim wants to do some more, but I don't want to do another one. I mean, as profitable as it was, and it really was, it could have easily just been a big nothing. And
yeah,
you know, it's sort of like going to Vegas. You know, I mean, sure, some people win, but I just can't afford the distractions anymore. It was fun while I did it. I spent like, I don't know, 4 months being distracted, and it was actually quite stressful. And I spent a lot of my life that way.
yeah.
And I just, now that I'm doing Gerson and everything, it's taken so much time that I just can't afford to be that distracted again, right now at least.
Yeah, I wonder if he'd be open to doing something, since it sounds like, you know, if you're not interested in doing another deal like that one in Alaska, then I'm actively working to look for parks too, so we can maybe work together some.
Oh, yeah.
A little bit about that.
Yeah, you totally should. Yeah, because, you know, he and I have still got that list of off-market deals. We've got, I don't know, 120, 140 self-storage deals, and I don't know, I think 45 mobile home park deals that were potentially available. And this was the one that I didn't even call in my first list. I was like, Fairbanks, and I skipped it. And then he called them, and it turned out to be the best deal that we had seen.
Nice. Yeah, we talked about, there was one, which I won't get into like where it is, but it's just crazy what some of the sellers want too, though. They were looking for basically a 7 cap price, and the whole park was in a floodplain. And it's one thing if it's like pooling water, but it looked like it'd be basically in the floodway with how close it is to a stream. So, but that was the only one in Virginia that we were aware of.
Yeah.
I got everything rolling on my end. We are live on YouTube, and it's been shared to Facebook and everything. So we might be able to get some people on both those platforms.
Okay, perfect. Well, we'll probably give it like another 5 minutes for people to get on. Generally, people are trickling on until 6:15 or so, and I know a few people are supposed to be. So this isn't on Facebook Live anymore, then, right?
It's shared. The YouTube Live link is shared on Facebook.
Okay, perfect. I know some people are looking to watch it from there.
So are we live right now?
Yep.
Mm-hmm.
On YouTube and 6:15
or so, and I know a few people are still.
Okay, so I'm gonna tell a story just while we're killing time, and I'm gonna ask you a question at the end of the story. You guys.
Okay.
And so hopefully it'll be entertaining, or at least something for the audience, and it actually will help me as well. What is he talking about? Okay, I got it. I mean, is that okay, or do you have something else planned for this?
No,
little
go
lag
for it.
time?
Yeah, that's perfect.
All right. Say, hey, everybody. It's really great to be here. I'm here all week. No, I'm just kidding. Stop it, Paul. Okay. So I got a story. Several men are in the locker room of a golf club, and a cell phone on a bench rings, and a man engages the hands-free speaker function, and he begins to talk. Everyone else in the room stops to listen. Man, hello? Woman, honey, it's me. Are you at the club? Yeah. I'm at the mall now, and I found this beautiful leather coat. It's only $1,000. Is it okay if I buy it? Sure. Go ahead if you like it that much. Great. I also stopped by the Mercedes dealership and saw the new 2020 models. I saw one I really liked. How much? $85,000. Okay, but for that price, I want all the options. Great. Oh, and one more thing. The house we looked at last year in Harrisonburg's back on the market. They're asking $950,000. Well, go ahead and make an offer, but just offer $900,000. They'll probably take it. Okay, see you later, honey. Love you. Love you too. The man hangs up, and the other men in the locker room stare at him in astonishment. Then he smiles and asks, I wonder whose cell phone this is. See, there's actually a point to this story, though. So Chase and Matthias and anybody else who can answer, who are we talking to tonight? It's really important to know who you're talking to. And so I would love to find out, not just, I mean, it doesn't have to be everybody answer, but I mean, if you guys can just give me a little more information, who we're talking to, and where people are in their journey. So be great to know.
Should we do a round robin and have people kind of introduce themselves? Would you like that?
We could unmute them for a little bit.
Whatever you guys decide to do would be great. I was just trying to kill some time with an amusing story, but I thought that it might tie into what we're doing too.
Kevin, do you want to start us off?
Yeah, we can just, like Matthias doing, mute everybody.
Yeah, sure. Hey, good evening. My name is Kevin Shufflet. I am a military officer. I also have a real estate business here in Harrisonburg. I've bought houses for going on, 18 years, I guess. Hasn't been my full-time gig just because of the military stuff. It's kept me busy, but I have enough to keep me busy on the real estate side. I've never sold any of them. I just buy, renovate, and rent. So always looking to hear from people that are doing as much stuff as you are doing. So thanks for doing this for us.
Man, Kevin, thank you for serving our country. I mean, at times like this, it really is a reminder. I spent the evening last night with a veteran from Kuwait in Iraq, and he's still very, very, I don't know how to say it, but anyway, he still bears the scars of that. And I really just want, whatever you did in the military, thank you.
Yeah, my pleasure.
You bet.
Let's see. Matt, you want to jump in?
If you're open to speaking too, you can put it in the chat, and then we can mute you in the order that you say in the chat. That way, if you don't want to speak, then we just won't go to you.
Can I not speak?
Can you hear me?
It's a little too late for that.
Okay.
Can you guys hear me?
Yeah, we can hear you, Matt.
Okay, cool. Kate's here with me too. So we're newbies, I suppose. Our real estate investments started about 2 years ago with splitting our land from our house that we lived in, selling our original house and building a spec house on the empty lot. We then used the funds from that sale and bought a duplex downtown, which our tenants are out of now, and we're about halfway through renovating. We flipped a house in Stanton over the summer, and so we're trying to wrap up some of these things and get on to the next thing.
That's awesome. You know, my first investment, I've been talking about real estate investing for 4 years now on Bigger Pockets and such. It never occurred to me till just this second that my very first real estate investment was splitting my lot off the side of my house as well in Detroit, Michigan.
There you go.
Back in the 40s. No, I'm just kidding. Back in the what year was it? 90s, in the early 90s.
Yeah.
I guess I've been investing longer than I thought. Okay, good. No, thanks. That's great. Well, congratulations on a couple successful investments already. That's wonderful.
Yeah, thanks.
You bet.
Thank you. Looks like Bill's next. And Debbie.
Hey, my name's Bill Russell. I actually grew up just outside of Detroit myself.
Oh yeah,
moved
where?
out here about 13 years ago. Lived in Redford and then moved to South Lyon for the first portion of my life.
Oh, that's great. Yeah, I used to live really close to Redford.
Yeah. I own a property management company down in Waynesboro, Virginia. And as of today, I'm under contract for my 5th single family rental for myself as well. So just kind of growing my own portfolio while doing the business.
That's great. Congratulations. That's wonderful. When did you escape? I mean, when did you move out of Detroit?
Gosh, so I came down here about 13, 14 years ago. Time flies, I guess.
That's great. Well, good. Well, congratulations. Sounds like you're doing great.
Getting there. Thank you.
Thanks, Bill. We can get Devin in now.
Hey, Devin.
You might have to unmute yourself.
How's that?
There we go.
There you go.
Okay. Hey, Paul, how you doing?
Great. How are you?
Okay. Hey, I've been doing buy and hold for 40 some years. I'm retired. My wife and I are retired. We've been doing it for a long time.
Wow.
And now but I'm trying to find exit plans for these rentals, and one of them is getting into syndications. I'm in 6 right now, and
wow.
One of them's your fund. You're number 2. I'm into that one.
Awesome.
And got my first payout here November 1st. So thank you very much.
Oh, you're welcome. I'm so glad to hear that. That's great. And that's a great exit plan, especially with the bonus depreciation that's happening right now. You haven't even experienced that yet, probably, at least in our fund you haven't, but it is such a great exit plan that the Congress and the president and such created for us in late 2017. It won't be there forever, So.
Yeah, one of the things I found out in doing the syndications is the what do they call it when they do that accelerated depreciation? They go in and
cost segregation, accelerated depreciation. Yeah,
you can use that to offset a lot of your taxes from the sale of your rental property.
Yeah,
and you can almost wipe it out in most cases, which is fantastic.
Isn't that amazing?
I know. I mean, I've also just recently invested with, you probably know Matt Faircloth.
Oh, I love Matt. He's great.
Yeah. And I mean, they're looking at a minimum of like, if you had like $100,000 investment, I mean, they're going to have a cost segregation of like 58% of that, this year. And it could go up depending on how many people continue to invest in the syndication. So there's a lot of benefits from doing those projects.
Yeah, there sure are. You might be surprised to find out that mobile home parks, from what we know, there may be other ones that are better. I mean, ATMs and things, I wouldn't count them as real estate, but mobile home parks have the strongest bonus depreciation of anything. And the surprise is, people think, oh, it's just land. you can't depreciate land. Well, there's a lot more to it. It's very surprising.
Yeah. Well, I think I've kind of narrowed it down to about 3 people that I would love, to keep on investing with. You're one of them. And
Thanks.
Matt's one. And then probably maybe, passiveinvesting.com, Dan.
Oh, Dan Hanford. Yeah.
Yeah. I might do him, but I'm not 100% sold on that one yet because they do pretty much Class A properties almost across the board.
Oh, do they?
And they haven't really closed on anything. So it's hard to say if their exit plans work out as promised.
Okay.
Whereas everybody else has some track history, I think.
Yeah. Dan's a good guy. I think he'll do well.
Yeah. Yeah. So that's my story. I'm sticking with it.
All right. Great to talk to you, Devin.
Good talking to you.
All right. Well, Paul, if we're all set, then what we can do too is generally we kick these meetings off with just a brief market report. We'll just basically show what's going on in our local market here in Harrisonburg. Mateus always has one put together that we show. We can either do that at the beginning or at the end, since you've already got everything going. If you'd like to just kick off and talk a little bit about your journey from newbie to commercial real estate fund manager.
Yeah. I mean, I'd like to hear the market report as well, but you want to do it at the end, you say?
That works. Yeah.
That works for you, Mateus?
Yeah, absolutely.
Okay. Yeah, we can do it at the end then. That'd be good.
Okay. Fantastic. Well, thanks again. It's really an honor to be here, guys. And I'm amazed that you have me here, and it's great to have this opportunity. Yeah, I'm going to talk about my journey from newbie to commercial real estate fund manager. I sold my company in 1997 to a publicly traded firm. I started investing in real estate in 99, except for splitting the lot off, so Matt reminded me of that. That was good. But anyway, I've written a couple real estate books, and one including, of course, I usually don't share this, but I wrote a book called The Definitive Guide to Smith Mountain Lake Real Estate. And so some of you probably know about Smith Mountain Lake, and it's a place that, it's really close to us here. So that really helped me a lot. And then I'm writing a book called Storing Up Profits, Capitalizing on America's Obsession with Stuff, which is a book on self-storage in the spring. It's coming out in the spring. Warren Buffett's Rules for Real Estate Investors. I assume it will come out approximately 2022. Just need to finish a few more chapters on that, but haven't gotten around to it. But anyway, I've been doing a lot of stuff, and I used to want to put serial entrepreneur on my business card, and I was pretty proud of that. And actually, I think it was a big mistake. My friend Barry ran for governor of Colorado a few years ago. And Barry said that he rubbed shoulders with some very high level people, some billionaires. And he said, the difference in the billionaires and most of us, and he was actually saying me and him, because we partnered together on a bunch of these deals. He said the difference is some of these people found a niche in their teens or in their early 20s, and they stuck with it. And they said no to 10,000 distractions along the way. And he said those people were the most successful people of all. People like Warren Buffett, who decided at age, I think it was 9 or 10, he wanted to be an investor, and he stuck with it. And he said no to tons of things he could have done. Bill Gates was an example. In his teens, he decided to be, a tech guy, and he never wavered from that, till he retired. And now he wants to take over the world, but that's another story. And so I think it was a big mistake to go on this long journey that I did, that some of it, but I'm also finding that providentially, those things that I thought were such a waste of time, such a bunny trail, at the same time, now I'm seeing them all, not all, not the Amway thing. Sorry if I offended anybody, but seriously, a lot of the stuff I did really fits in now. For example, in 2003, maybe, I think, I got on a bunny trail and I went to work briefly as an independent contractor, 1099, for a cost segregation company. I'm like, cost segregation, what that has nothing to do with anything. 3 months later, I was out of there. The company ended up folding. And then now here we are like 16 years later. And I'm like, oh, I understand cost segregation studies. And that helps me understand bonus depreciation. So that's really good. But again, I would never have charted the course. If I could start over in my 20s, I would not have charted the course I have, because I just made a lot of mistakes along the way, just way too many bunny trails. I mean, after all, I got a podcast called How to Lose Money. And I could, on this show, we've done about 235 episodes, and we've talked about a lot of things, and I could get really depressed if I let myself, thinking about the penny stocks that were going to blow up, and they really did blow up. Not the way I expected. As I think about the Charlotte entrepreneur that I invested with, who had a way to get 35% annual returns from trading something. Wasn't clear what he was trading, except I know he traded his life in for a 158-year jail term, because he built 2,000 investors, including me, out of $18 million total. And he still won't tell the feds where he hid that money offshore. It's strange. Or the waterfront home I built at Smith Mountain Lake in Virginia, and I should have made an $80,000 profit on it easily, but instead I lost $40,000 because I wasn't a builder. I didn't even know how to tighten the doorknob on my own house. And so I made a lot of mistakes along the way, but the great news for you is you don't have to. You all have resources like this investor club, or like Bigger Pockets, or like hundreds of podcasts that can give you information that if you apply it, you won't have to make the same mistakes I did. And you won't have to make money, then lose it, make money, then lose it, and chase shiny objects. You'll be able to do something really powerful that's really, hopefully really focused, more focused than mine. I promised to talk about my journey from Newbie to commercial real estate. So, when I originally got started in flipping houses, I didn't know the power of commercial real estate. I had a sense that there must be some reason a lot of wealthy people don't flip houses anymore. And some wealthy people do flip houses, but I mean, some of the mega wealthy people, like the people with family offices, or people, with, billionaires, when they're in real estate, they're typically not doing the stuff I was doing. And I think that a lot of people end up graduating up to commercial real estate. Not everybody. I mean, there's a lot of great things you can do, not in commercial, but my personal journey ended up in commercial. I'm going to get back to why I switched from residential to commercial in a few minutes, but I just want to drop this thought in your brain. And that is, if I took the house on the left, and it's, if you look close, you can see it's not the same house on the right, but I was trying to make you think it was, maybe, kind of, sort of. But seriously, if you took a house on the left, and if you could remodel it, I mean, if you could pay $100,000 for that house in Stanton, let's say, and let's say you could just beautifully remodel it. You could put in 4, 5, 600,000 and turn it into the house on the right. You could architecturally remake it. You could add those porches. You could move it to Charleston, South Carolina with the palm trees. But anyway, that's beside the point. If you could somehow do that, but you're in a neighborhood, now you've got $600,000 in this incredible house, but you're in a neighborhood of $300,000 houses. You know this, you're probably not going to get your money out of that house. You're probably not going to make back all you have in it. And I've done this. I flipped probably 60 to 80 homes, and at least 3 times we overdid the house for the neighborhood. One time extremely overdid the house for the neighborhood. And so I'm speaking from personal experience, and that's probably part of the How to Lose Money story. But I commercial real estate is different. And in a few slides, I'm going to tell you how powerful it can really be and how different it could be. My first foray into commercial real estate was as a little kid in Dayton, Ohio. They started the Dayton Mall. I heard it was the largest mall in America. I don't know if it was at the time, but I was amazed with the marble floors and the elevators and they had 29 shoe stores. It was like really impressive. This isn't the Dayton Mall, because if you pulled up a picture of the Dayton Mall today, it would look more like this, because you know how this goes. I mean, the malls in your town, or they're in a certain part of town that was really popular in the 70s, but now the town has moved on. And the retail strip centers like this, or some of the malls, they're kind of in a junky area now. I know in Roanoke, if you go to the DMV in Roanoke, it's in what used to be a pretty nice mall before Valley View Mall and Tanglewood Mall came in and completely dwarfed it. And now that so-called mall is a bunch of offices. It's a DMV. It's maybe a flea market is in some of these places. And so I noticed this as a really young person. I was like, these people with this commercial real estate, they're bad investors, I guess, because look at all these boarded up places, and look at this downtown that has all these boarded up, buildings. And I think that that's a really bad idea. So when I first thought of commercial real estate, I mean, when I was younger, I really thought it was a really terrible investment. I remember in Detroit, we were looking for a new office in Troy, Michigan, and we went to an office. We clipped out, there's this thing they used to have. It was white with black ink on it. It was called a newspaper. And there was these, I would clip out these ads for, commercial office space so we can find a place to put our company. And I'd go there all excited. I was like, wow, this is only $800 a month. And I'd get there and the building was half empty. It wasn't as bad as this one. But I thought, gosh, the person who built this building in the 50s probably did really well in the 50s, 60s, 70s. But now it was the 90s and the building was old and it was getting run down. And it looked like the carpet hadn't been changed or even cleaned in years. And I just thought commercial real estate must be a really bad idea. But commercial real estate, again, going back to this comparison to residential is based on comps, but commercial real estate is based on math. Jeff Bezos understands, I don't know if it's Bezos or Bezos, someone correct me, but he understands this math. And Jeff Bezos went to all the vending machines in Amazon facilities all over America and the world, and he took the light bulb out of the top part of the vending machine. Why would he bother to do this? The guy's the wealthiest guy on the planet. Well, that's one of the ways he got there. He got there because he knows the power of the commercial real estate formula. Even though he doesn't do real estate, he has a similar formula for what he does. Jeff Bezos knows that if you have a light bulb advertising Lance snacks at the top of your vending machine, it's burning up electricity, it's maintenance cost to come change that light bulb, it's the cost of the light bulb, and that's a waste. Jeff knows that if $1 added to the bottom line of his company is worth a lot more. Here's kind of an example of how much it could be. If somebody knows the PE ratio, the price to earnings ratio on Amazon stock, they should tell me quickly before I say it wrong, because I haven't checked it for a long time. But if he can save $1 on a vending machine, the electricity for a bunch of vending machines in a factory or in a warehouse, I should say, $1 a month, that's $12 a year. Well, $12 a year is added to the bottom line of their company, but that's multiplied by the price to earnings ratio of the stock. And let's say that's 30. Well, 30 times 12, that's $360. That $1 he saved per month turns into $360 in Jeff and all of his investors' pocket. It's a very powerful math formula. And commercial real estate has a very similar formula. And I think this is why most of the Forbes 400 invest in commercial real estate. Let's do the math. So $1 a month added to the bottom line turns out to be $12 added to the bottom line annually. My mom told me I was good in math. And the way it works is the value in commercial real estate, a lot of you guys know this already, is the value is the net operating income divided by the cap rate or the rate of return. So it's $12, again, $1 a month, $12 a year divided by 0.06. 12 divided by 0.06 is $200 added to the value of the asset. That's really powerful. I mean, $1 doesn't sound like much, but 200 does. So if you can save, if you can add $1,000 a month to your bottom line, that's $12,000 a year. Well, that's $200,000 added to the asset value. We're talking real money now, but it's even better if it's leveraged, because if it's leveraged at 60%, by the way, 6% cap rate and 60% leverage, those are just examples, nothing more than that. But they're pretty common examples. $200 added to the asset value, might be the leverage on that might make that into more of like a $500 improvement to the bottom line, or the equivalent of $500 to the equity holder's pocket. So it's pretty powerful. Here's some examples. So if you filled 800, I'm not going to do the math on all these for time, but you can do it. If you filled 15 vacant apartments at 825 a unit, well, that's 15 times 825 times 12. Divide that by the cap rate. We're talking, I haven't done the math, but I'm saying well over $1 million added to that value of that, let's say 100-unit apartment complex. That's pretty powerful. Or if you save $25 a month on client water bills, let's say by, metering the water. If you raise lot rent at a mobile home park by just 5% on $300, that's $15 a month. $15 a month. Let's just do the math on this one. So $15 a month added to the bottom line times 300 spaces. So that's 15 times 3. I did it wrong already. 15 times 300 times 12. Okay, so that's 54,000. Just raising the lot rent by 5% on a 300 space mobile home park. That's 54,000 a year divided by a normal cap rate of 6%. You just added almost $1 million to the bottom line. Well, raising the lot rent by 5% on a mobile home park that's already way under the market rents, that's not too hard to do. It's not too surprising. It's not egregious. Well, that's something that's very doable. And that's the power of commercial real estate. Getting a cable internet deal. That's an apartment deal there. Spending $100,000 to add paid outdoor storage. Now, Devin, you'll like this one because this is an example from our fund. If one of our operators spent $100,000 because he came in, he looked around at a mobile home park and he said, hey, there's 2 cars parked in front of a lot of these mobile homes, but some of these mobile homes have 3 or 4 or 5 or 6 cars parked in front of them. And some of them have a boat and an RV or a work trailer. And this place is a mess. Some of these cars are on blocks. So he basically paved an acre and he put a nice fence, a nice gate around it out front. And he said, okay, everybody who has an extra vehicle has to go in here and you have to pay us a small amount a month. Well, when this 1 acre is almost full with people from the park, they'll actually put it on Craigslist. They'll fill it up from the community, boat and RV storage. Well, that's $100,000 he spent. That's going to result in $9,000 a month added to the bottom line. And there's no additional costs after that. $9,000 a month times 12 months is $108,000 added to the net operating income, which is great for the investors, but that's 1.8 million added to the value of the property. Let's say this was a $5 million property in the first place. So now they have 5.1 million in it because they spent 100,000 on this. Okay, so $5 million property. Let's say it's 3 million in debt. That's 60% again. $2 million in equity. Well, if you take $2 million in equity and you just add 1.8 million to the 2 million, you just almost double the value of your equity just by adding paid outdoor storage. That's before they raised rents and did 100 other things they could do to add income. So it's very powerful. Adding U-Haul storage to a self-storage facility, that can be $3,000 a month. That's $36,000 a year. That's something like $500,000 or more in value added. That's just from signing a contract with U-Haul. Adding point of sale items at a self-storage, adding insurance and late fees. I mean, even $5 a month, it really, really adds up. That's about a $500,000 add right there to the bottom line. So that's why this math formula, if I had to pick one reason I jumped into commercial real estate, that's it. And, you know, I think that it'd be great. I don't know if you guys want to, but Mateus, Chase, if you want to stop for a second and ask me any questions, that would be a good break point to ask before I launch into the next part here.
I believe Devin may have a question. Devin, do you still have a question?
Give me a second here to move. I'm at a birthday party for my grandson.
Oh, happy birthday, grandson.
So I was just watching it. Okay. One question I had is, I know you guys on that Fund 2.
Yeah.
You sold, I think they sold a couple trailer parks. No, I would say trailer parks, mobile home parks. How's that work when you distribute the profits from that to the fund? How's that usually work out?
So we have about a $14 million fund right now. I'm just telling everybody else, you know this, Devin.
Yeah.
And we have, up until very recently, we had about 25 assets in it. We just added 51. So now we have 70 something assets. I say 70 something because we also got rid of 3. We sold 3. So let's see, we sold a self-storage facility, and then another. Yeah, we sold 3 self-storage facilities, and we're under contract to sell a very large mobile home park. Well, when we sell, you know, investors in year 1, we've decided from talking to a lot of investors that they don't want to get an excess return. They're in it for the long haul. And so, and there's also the bonus depreciation, which we were talking about before the show, and we can definitely talk about again later. The bonus depreciation under the new tax law allows us to write off a lot of the first 1, 2, 3 years, specifically in profits. In other words, if we make a profit in year 1, 2, 3, 4, it's usually reported as a loss. I should say if we make positive cash flow, it's usually reported as a loss. That's more accurate. So there's not going to be a lot of taxes due. So we like to reinvest proceeds. So we just made $157,000 from the sale of 2 of those assets in Fund 1. I think in Fund 2, the one you're in, we made about $130,000. We have a smaller amount invested and over a shorter time. And so we reinvested that immediately back into other assets that Wellings Capital really has vetted and likes. Later, when we sell, like there's going to be a time in year 3, 4, 5, 6, we don't know when, where when we get checks like that from operators when they sell, we'll be distributing that to the investors as part of the return of principal, return of capital, and also as a return as a profit. Does that make sense, Devin?
Yeah, it does. I like the idea of reinvesting.
Yeah, me too. A lot of people yeah, go ahead.
I mean, because it's only been like 6 months and it seems like, well, it's nice to get a return, but you know, right now I'd rather put it into it and can make that thing continue to grow. Just keep adding on.
Yeah, I think a lot of people wish, including me, that we had a way to easily reinvest all the distributions along the way back in to grow our principal, but it's It's extremely hard to do that because of the way our fund is set up. We, the way the fund's set up, there's just no easy way to reinvest small amounts because we only invest chunks at certain times as we, as we see fit. So it's not easy to invest, $1,000 here and there is what I'm saying. It's not like a mutual fund. You know what I mean, Devin?
Right. I know there's some syndicators are starting to set up a fund that you can invest in that can be used. They'll use it for, let's say Chase comes to the fund and says, hey, I got this building I want to flip, but I need X number of dollars in order to make it work. So that fund would loan them the money at, it's like a hard money loan. They might loan it out at 10, 12% and so many points or something like that. And so the people that are invested in that fund will get the proceeds from that.
Mm-hmm.
And it doesn't have to be those big chunks like you're talking about, because, I know most syndicators, they want, 50,000, 100,000, at a time, which can be difficult when you get payouts. And you say, well, I want to get, say you get $1,000 payout. How are you going to put that?
Yeah.
You'd have to put, X number of dollars with it in order to keep investing.
Mm-hmm.
So if you had a fund, you could put it into to kind of roll it over into to keep on growing for you and keep your money working.
Mm-hmm.
Might work out. But
I've thought of that too. I actually thought about adding, investing some of those distributions in like PPR Note Fund, which is Dave Van Horn's Note Fund. I think that would be a great idea.
Yeah, that sounds fantastic.
Yeah, it's a good thought. Thank you.
Yeah.
Anybody else?
We've got one question from Masha. She says, what skill, knowledge, or relationship do you wish you started gaining earlier in your career to become a fund manager?
Well, this may not be the right answer, but this may not be what you want to hear. But I would say, though, for me, the ability to focus. For me, my particular problem was chasing shiny objects. I love marketing. I love, copywriting. I love the opportunity to do something new. And as an entrepreneur, I call this, with a little bit of disdain in my voice, I call this entrepreneurial investing. Paul Samuelson was the first Nobel Peace Prize winner in economics from the US. And he said, if you really want to invest rather than speculate, he said, investing should be more like watching grass grow or watching paint dry. If you want excitement, take $800 and go to Las Vegas. The point is, if you want excitement, go be an entrepreneur, go like invent something, go figure out SpaceX, Tesla, something like that. But investors, really, really good investors, are patient. They're boring and bored a lot. I shouldn't say they're boring, but I mean, Warren Buffett is, according to him, over his 50, 60 years, he's been a really, really boring person for the most part. He has been the kind of person who sits in his office. He doesn't meet with anybody. He doesn't talk. He reads 500 pages a day of reports. His life is quite monotonous. Well, we talked about Jeff Bezos earlier. He said to Warren, he was in Sun Valley, Idaho with him at this big billionaires conference. And he said, hey, Warren, your strategy is not that hard to understand and follow. Why doesn't everybody just follow you? And Buffett reportedly said, oh, no. People don't want to get rich that slowly. So I would say it's the ability to say no, the ability to have very keen instincts, have very keen due diligence practices. By the way, for due diligence, I would read Brian Burke's book called The Hands Off Investor, which is teaching you to invest in syndications and teaching you to invest in passive deals, teaching you how to vet people. That's really good stuff. And so I would say that, focus, the ability to say no, the ability to be tenacious, the ability to not chase shiny objects. Those would all be things that I find really important.
Perfect. I have two quick questions too for you.
Yeah.
That first example that you said with the parking lot, was that one of Ryan Smith's deals, or who was the operator? It was?
Yeah, it was Ryan Smith.
Okay, cool. I was just curious. I thought maybe I heard that story before.
Yeah, Chase, that was Ryan Smith, and I don't know where, I can't remember where it was, but
okay.
yeah.
That's pretty, yeah, that's really really smart with that. And then the second question, I'm gonna kind of get your opinion on if you want to answer it now or wait until we get further on the presentation some, but would be if someone is currently a residential investor that's looking to get into commercial and do a lot of this stuff that we're talking about, what would your advice be? What would be their best way? I don't know if you want to address that now or further along in the presentation.
Yeah, I can try. I got, you know, I think I'm going to do this. I didn't have a slide for this, but I should have. There are 7 paths to go from residential to commercial. And why don't I answer that now? Because I don't want to run out of time and forget. That's so important. So I did not think of having that slide in here. So great question. This is in my new self-storage book. And so hopefully I'll remember at least 5 or 6 of the 7 paths. I'll probably be able to remember them all. So these are paths if you're starting in commercial real estate, like if you're just, you know, kind of a newbie and you want to start in commercial, or if you're in residential and you want to go into commercial. 7 paths. So path number 1 would be to be a deal finder. A deal finder is somebody who goes out and beats the bushes. They try to find deals. They get to know brokers. They get to know sellers. They might set up a system, mailing letters or calling. And what they do is they arrange a deal with a commercial real estate syndicator or operator. And they say, hey, if I bring you a deal, let's talk about parameters that you'll cut me into the deal. And the goal will be that you get a piece of the deal, you stay in the deal, and you learn the business from them. So if I found a mobile home park and I couldn't take it down or didn't have the knowledge or the debt capacity to take it down, I might send it along to somebody else and let them be the operator. And I stay in, let's say I get, all right, so let's say 10% of the general partnership. What I mean by that is in a syndication deal, there might be a 70-30 split. All the equity investors get 70%. And then the syndicator, operator, general partner, whatever, gets 30%. Well, as for part of bringing the deal, I'd say, look, give me 10% of your GP, 10% of your 30%, in other words. And that would be an example. And then I would get to stay in. Rather than getting a real estate commission, I would get ownership. You can also get a commission as long as it's legal. You can't get a real estate commission, of course, unless you're a realtor. Even if you're not a realtor, you can stay in the deal like that. Just be careful how you structure it. So that's one way to do it. Deal finder stories. There's so many. So I found a mobile home park deal along with my friend Tim Henderson in March, and we got it under contract in July. And we were passing it along to a great operator. I'm not an operator, a mobile home park operator myself. We were passing along to a large operator. And then in August, Fannie Mae and Freddie Mac bailed on the deal. So my operator friend bailed. And so I decided to flip that and just take a quick profit. And we're closing on that this week. So that's a deal finder. Second path would be to be a money finder. Now, until recently, or until soon, does that make sense? Till soon, I don't know what that means. You're not allowed to get paid as a money finder unless you're a broker dealer. So if you're a broker dealer or a registered financial advisor with a certain license, you can get paid a percentage of the deal. But otherwise, you're not supposed to get paid a percentage of the deal. You're supposed to get a flat finder's fee. Well, there's a lot of people on the internet the last 5 or 6 years selling courses and everything about how to get a percentage of the deal by being a money finder. Hey, look, you got a $10 million equity raise. I'll bring $1 million of it. You give me 10% of your portion of the deal. Okay. And then somebody else comes along, and I had a friend recently who raised $11 million for a $32 million raise. He sold dental equipment. He literally sold dental equipment for years. And then he decided he wanted to get into real estate. So he went back to all the dentists while he was still selling equipment and said, hey, you got time to meet after work? I want to tell you something. He raised $11 million out of the $32 million deal.
Wow.
So he got paid really, really well, like 3% or something. So he probably made $330,000 on that 11 million, if I did the math right in my head just now. So that's a money finder. The reason I said it might be illegal till soon is the SEC has really hated this type of thing, but they've just indicated that they might loosen up their standards in the next quarter, or their guidelines, and allow people to get paid to raise money or get a piece of the deal. A third path is to just be wealthy and jump in. I mean, that doesn't sound like a path, but it really is. Like sometimes somebody, like we talked to one of our investors is a pro football player who's retired. Well, he had money, so he could jump right in to a large deal. Somebody else I know was, they won the lottery. All right. I actually didn't know them, but they jumped into deals with their money. I know of them, I should say. Somebody else was the child of a very wealthy person. They had wealth, so they jumped in at a large level. I recommend, if you ever do that, like, to really get a phenomenal team around you, get experienced people around you. I know a guy in Palm Beach, Florida, who did that. He jumped into self-storage investing in 2013, and he was smart enough to get some of the top pros in the industry. He and his wife were both grandchildren of extremely wealthy people, like people you would know of, that kind of wealth. And they jumped in, but they got incredible teams of people around them so that they were able to really succeed. So that's the fourth path. Another path is just climbing the ladder. Brandon Turner, I think, calls it stacking. And stacking is when you basically you buy a duplex, fix it up, sell it, and then you take the profits and you buy a fourplex. And so that's something, Matt and Kate, you might want to try to do. Take your duplex, fix it up, rent it out, sell it, either refinance, or some people argue that the better way to do is just sell it at top of the market, then buy another one, a fourplex, and do the same, then buy an eightplex and do the same. I know a guy that started with $1,000. I know this guy personally, Arlington, Texas. He got $1,000 bonus at work in 1993, and he bought, somehow or another, he got a bank-owned property for real cheap with $1,000 down. It was a duplex, and they met him in 2015. He was in a 132 or 138 unit apartment complex in Dallas area. Literally started with $1,000. Now he worked really, really hard. That's a proven path, but it's a really hard and long path. But I mean, it's definitely doable, more than some of these. Another path is get a job. And you guys might say, wait a minute, I came to the Harrisonburg Real Estate Investing Meetup because I didn't want to have a job. I wanted to get out of this job. Well, you can get a job as a property manager and learn property management. One of the top, Rick Graff, I barely know him, but he's in Dallas. Rick Graff's one of the top apartment owners and property managers in America. I mean, one of the literally top 5, I think, as far as, I think he has 185,000 units under management as a property management firm. He's the CEO. Pinnacle Properties. He started out with a job. In college, he was a porter, like a maintenance guy at the apartment complex in his town. And that's how he started. So it's possible to do it. Gary Keller started as a realtor. Of course he did. He's now the most famous realtor in the world. So it is possible to get a financial analyst job, property management job, asset management, real estate broker, or mortgage broker. To me, those are the 5 top jobs I would recommend with the get a job category. Path number 6 is become a passive investor. And Devin has done that. He said, look, I'm trading in my active role. I'm tired of managing this stuff. I'd rather be a passive investor. So being a passive investor is definitely a role that I recommend. Of course, that's what I do. I manage investments for passive investors. And so that means we take a little lower percentage split, but by finding the very best operators to invest with, we get, in theory, more money in the long run because they know what they're doing more than I do in self-storage, mobile home parks, multifamily, whatever it is. So the passive route is the 6th of the 7 paths. And the 7th path is find a mentor or coach. A mentor would be somebody maybe in your town that you could just go to work for and say, look, I'll bring you my skills doing, let's say, SEO or apartment maintenance or Excel spreadsheets or whatever it is you do. And you say, look, I'll do this for you for free, but I want to hang around you, shadow you, go to your meetings and learn the business. So that's the mentor path. The coach path, of course, is finding a paid coach and paying them, maybe it's $20,000, maybe it's $50,000 to let them coach you for a year or years. The 2 best businesses I've probably ever been in started with me paying $25,000 to a paid coach. It just happened to be 25 for each. And including multifamily, including commercial. That's how I got into commercial real estate. I told you why I did it, but the how was, I'll probably just use this as a transition point to my next, unless you have more questions.
No, that's great.
So I was struggling with trying to figure out how to get from residential to commercial, didn't know how to do it. I actually loaned money for a commercial deal once and I got a profit on it. And that was nice, but that wasn't, something I wanted to do long-term. And so I ended up building a multifamily. My friend and I invested in oil and gas in North Dakota during the Bakken oil boom. And when we did that, we found that there were 18,000 job openings in North Dakota. And a lot of the reason was there was no housing. There were men and women, mostly men, sleeping in their trucks, pickup trucks, station wagons, along the side of the road, in Walmart parking lots. These people were making 90 to 120,000 a year, but they're sleeping in their car because they couldn't find a place to live. Hotels that had been $99 in small towns were now charging $400 a night. And so we decided to quickly build a multifamily facility, and we very quickly bought 75 acres and we built, and then we operated that for a number of years. That's how I got into commercial. I didn't know what I was doing at all in this, but we made it work because the boom was so powerful. We were charging $4,000 a month for a 300 square foot furnished efficiency. And that comes out to $129 a night. So it sounds really good compared to hotels. And it sounds really expensive compared to apartments. But that's what we charged. And we had the time of our life doing that. But when I got out of that, I decided, hey, I really want to get into multifamily. What do I do? And so I hired a paid coach, and it was in Richmond, Virginia. It was called 37th Parallel. Some of you have heard of them probably. 37th Parallel is a coaching program for people who want to get into multifamily and all kinds of syndication. And so I hired them for $25,000. I was with them for a year, pretty intense for a year. And then they gave me a lifetime support as a result. Now, I love coaching. I don't like hiring gurus, the kind who will get you into a weekend seminar for $149, and then they'll sell you a $10,000 seminar, which will teach you almost enough, but not quite, because now you need to spend $20,000 more on their next seminar that will teach you almost enough, but not quite. And so I don't recommend that, but I do recommend coaching, paid coaching, mentoring, all that. I think it's a great path to get into commercial real estate. So I jumped into commercial real estate. I did that. And then after I did the mentoring program, I started banging my head up against the wall trying to find multifamily. And, you know, they say that those who don't do teach. Well, in my case, those who couldn't do wrote. And so I ended up writing a book on multifamily investing. It's called The Perfect Investment. And that book is still selling pretty well. It was written in 2016. And that book was something that launched me into the rest of what I'm doing in commercial real estate. Now, I asked the question at the top here, why is a multifamily author who promised his wife he would never do anything but multifamily not investing in multifamily right now? Well, I banged my head up against the wall for years, and that led me to some conclusions, which I will tell you about in a minute. I love multifamily. This is a graph showing what happened in American home ownership over the years. American home ownership was, you know, generally in the 60 to 65% range for most of history. And then in 1993, 1995, under Bill Clinton and the Congress there, they decided that everybody who could fog a mirror should own a home. And so they made it really, really easy to get a mortgage. Those of you who remember what it was like, it was crazy how easy it was to get a mortgage. I kid you not, a friend of mine in Roanoke, Virginia, he was making 40 or 45,000 a year. He had like $100,000 house. He decided to buy a $500,000 McMansion. Actually, it was a mansion in the town he grew up in West Virginia. It was a small town, and he wanted to prove to everybody he was successful. He got a $500,000 mansion as a second home, and he qualified for this loan, 100% mortgage. And it was crazy. And he had some scheme. This is before Airbnb, obviously, way before. And he had some scheme of renting it out and doing this and doing that and refining and all this. Anyway, he lost it back to the bank in a few months. It's crazy. But anyway, home ownership in America went up from 63% to about 69.2% in a decade, from 95 to 2005. And people thought, oh, this boom's going to go on forever. Well, some of you remember that. And the boom did not go on forever. Actually, it started bursting in 2005. And from 2005 to 2015, in that next decade, homeownership dropped from 69.2% down to 63%. And this slide is obviously pretty outdated, because it has gone up again since then, and now it's leveled off again. So every 1% decline in home ownership was, 1 million new renters. Well, the problem was, or the great thing for multifamily was, in these same years where home ownership was sliding, during the Great Recession, the Great Financial Crisis, a lot of new apartments were not being built. Commercial real estate was in the dumps like everything else. And so there was a huge supply and demand inequity. And now we got all kinds of other people coming in who are renting more than buying. And so that made it even better. I'm going to take a quick break here and take a quick drink of juice. I'm a juicing fanatic. So I got this green juice, but study this graph, and then we're going to talk about it in a second.
Any questions while we have the juice break going on? If anybody wants to drop those in the chat.
This is so good. It's not that good.
I've got one lined up for you whenever you finish.
Yeah,
Paul.
go for it. Yeah, what's the question?
Let's see if I can word this right. So basically, you got into coaching a little bit, especially for people that are trying to get into commercial.
Yeah.
Let's say those price tags are $10,000, $20,000. What would you say to somebody? Because I know a big hurdle is if you spent that, you knew you could get it back, you get your commercial deal, then it's not a big issue, you know. But finding the right person, the right coach, and then also actually spending that money, a lot of people don't want to do that and then not have a deal come out of it.
I know.
I guess what would you kind of advise or say for that situation?
You got to be super committed, because I know a self-storage coaching program. All right, I'm not going on record saying this because I don't know for an absolute fact what my friend paid. I'm pretty sure he paid $100,000 to be in this mastermind coaching program that guaranteed him a deal. It guaranteed a deal where he would make at least $100,000 on his first deal. Well, here he is 3 or 4 years later, no deal. And he's actually getting back into house flipping, and he's really frustrated. I think he's pretty upset with the coach. Well, that's, you know, so if I just heard his story, I'd say, ooh, I'd never want to do that. I know another guy in Chicago who went through the same exact coaching program. He's the same age, and he's probably done 30 deals. I mean, a lot of them were flips, but he's done tons of deals. He did 7 or 8 deals recently in a short time. And so I think you know, it's the coaching program. If you've got all kinds of credentials on them, all kinds of references, you're sure it's going to work. You're sure people are happy with it. A lot of it's going to depend on your commitment. It'd be horrible to drop 25,000 and then not follow through. And I know lots. I mean, 80-20 rule, you guys know it. 80-20 in my class of like 10 people, I'd say at most 2 of the 10 are still going 5, 6, 7 years later.
And that's kind of the question too, is I don't want to act like I'm talking down on coaching. I think it can be a very good thing, but that 20%, generally, if they're that committed, then I just feel generally they're going to find a way to get through no matter what. I mean, coaching just speeds up the process, but
yeah, no, that's a good point. That's a really good point. That's where you might want to consider mentoring, you know, not an unpaid mentoring program where you just go in or maybe partner with somebody. One of the things I like about coaching and mentoring is if you really prove that you're committed, often the coach or the mentor will partner with you. In other words, they'll say, yeah, bring me a deal, we'll split it. That is a great way to get started.
Yeah.
And that's kind of going back to the deal finder, right? Why I love multifamily. So Freddie Mac, you all might have heard that during the height of the great financial crisis, there were up to 10% delinquencies with regional and local banks. Well, Freddie Mac and Fannie Mae do a better job underwriting, they say. They only got up to a 4% peak delinquency rate. And you can see that here in 2010. Well, look at multifamily. You can barely see it. It looks like the x-axis almost. It barely rose at all. It went up to 0.4% at the worst. And now it's like almost 0 for years. And so it's, you know, it was 90% lower than the single family delinquency rate. And now it's like 98% lower. And that includes California and Florida and Nevada and Arizona, those sand states where the rates were actually higher. And that includes bad operators, you know? So anyway, I think multifamily is quite safe. What drove the multifamily run up? Well, I told you the government, you know, getting involved. That definitely drove part of it. But there's also the demographics of this. So millennials and baby boomers were, until now, the 2 largest groups in America. You know, there's baby boomers, and this slide says echo boomers, you know, millennials. But there's another group now called Gen Z, of course, you all know, and that they're at about 75 to 80 million strong as well. I've heard up to 84 million. And they have, a lot of these groups are renting more than buying. So the majority of millennials rent. That's the nation's largest historical demographic group, and 54% are renting. You know, record student debt, desire to live in urban areas, access to transportation, the desire to pick up and move to a different city, different friends, different job next year. People don't feel like they want to be tied down to a 30-year mortgage. And so a lot of them rent, and that's great. I mean, I don't think there's anything wrong with that. A second group that is renting a lot is actually the fastest growing group, but still the smallest group, is the baby boomers themselves. The baby boomers are renting more and more, and statistics say when they rent, they'll never go back to owning again on average. And so that's my generation. A lot of people in both millennials and boomers felt like, hey, home investment is my greatest investment. Well, 2008 to 12 proved that was not. Ownership, obviously a run up in home ownership right this minute. It's also favorable immigrants. I mean, we have a lot of around Harrisonburg, and the immigration trends say that they're going to continue to grow in the coming decades. And the immigration trends say that, immigrants rent more than buy, and they rent for longer. And so that's just that. You're all hearing me okay, right?
You're breaking up just a little bit.
Every once in a while, yeah.
I'm going to take a risk here, and I'm so sorry. This might be a good time for you to share your local market stats. No, I'm not. I was going to reboot but I think that would not be good. Sometimes I can reboot in like 5 seconds with this little quick thing, but just the internet connection, that is, not the computer, of course, but I don't think I'm going to. Stop me if I break up too much and yell at me, okay?
Okay. Yeah, you're doing really well right now. It's not breaking up at all.
Now it might be frozen.
Yeah, I think you might be frozen now.
Come on.
There you
Okay.
Well,
did you say I'm frozen like the movie I have to sing?
Yep.
My daughter can come and give a solo if you'd like.
All right. Well, your daughter can, if I break up and go offline again, please have your daughter fill in the space. So why am I not investing in multifamily at the moment? Well, I just mentioned all the demographics, all the great reasons we love it, but the space is significantly overheated. Cap rates are at record low, which means prices are at a record high. And there's a lot of reasons for this. There's 1031 exchange investors coming in. They're willing, and I'm personally know 1031 exchange investors who say, I got to get this 1031 done. I don't care if I have to overpay. And they overpay. For some reason, IRA investors are also willing to overpay. They think of it as fund money because they can't use it now. Not all of them, not most, but some do. International institutional money, that money, sometimes they just they want to get into US dollars. I know a Chinese investment group that says, we will accept a 0% return just so we can own American real estate. And they had reasons for that they showed me on paper. But institutional money, life insurance companies, REITs, some of them, they are willing to accept a lower return to get stability. There's the Tax Reform Act. In 2017, November 2017, before the tax reform, people were pretty sure the real estate market had peaked. About 50% of people in a survey said it had already peaked. It was going down now. But in January, about half of those people said, maybe it hasn't peaked because the Tax Reform Act and the bonus depreciation added incredible fuel to the fire. If somebody asks me later, I'll tell you guys how Brad Sumrall, oops, I wasn't supposed to say that, how somebody took $2 million he was about to send to the IRS. Instead, he sent it as a down payment on a multifamily, and he did not have to pay the IRS at all because that's the power of bonus depreciation. I'll just leave it at that. But if you guys want to ask me more about that topic later, I can do. The Newbie impact. Chase, I've been trying to coin this new term, Newbie, but no, it's not catching on yet. Maybe it will tonight. Newbie, who are actually new. There are people who weren't even investing in real estate years ago, but now they've got on the craze, they got on the banding and teaching others to invest. And some of them have never seen a downturn, so they don't talk about downturns. I literally heard a guy on the stage in Miami, Florida at an event with investors say, invest in multifamily. It's only going up. It's never going to go down. And I sat there and thought, he's kidding, right? He's kidding, right? He wasn't. He was dead serious. And I would call him, sadly, a wolf in sheep's clothing, because I was leading people astray, because it's not true. And when Warren Buffett, famous investors over the last decade or century, they would tell you that you can't say it's just going to go up forever. Trees don't grow to, and neither do most investments. So multifamily has been great, but I've expanded into manufactured housing and self-storage. And hey guys, remind me how much time, when do I need to be done? Because I don't want to be too long-winded if that's possible still.
Generally usually wrap up right at 8 or a little bit before.
Okay.
But I mean, if you're on a roll and you have time and want to keep going, then by all means, don't.
Oh no, I thought you need to do Q&A and some other stuff at the end. So
yeah.
Okay. All right. Well, any questions that come in, just yell at me.
Okay, perfect.
So this is, you mentioned Ryan Smith. This is one of the Elevation Capital mobile home parks on the right in Gillette, Wyoming, we invested in. And the self-storage facility on the left is in an undisclosed location, because I can't remember where it is. So why I love self-storage. So it's recession resistant and it's strengthened in economic booms as well. When things are bad, people often are downsizing. There are, the 4 Ds you all have heard of: divorce, death, downsizing, and dislocation. Well, when people are downsizing, they often say, look, I'm going to go from this 4,000 square foot home to a 2,000, but I need a place to store this stuff. I'm not getting rid of it. Or maybe they're downsizing to an apartment, or maybe they're moving, they're dislocated. Maybe they're moving. Maybe they're in a divorce situation. Maybe they inherited their parents' stuff. So people are putting in bad times, putting stuff in storage. And in economic booms, they're buying more stuff and they need a place to store it. The rents are quite elastic. That means they're not particularly price sensitive. So I think I should have said that they're inelastic. I always get those mixed up. But anyway, if you raise an apartment rent, let's say it's $1,000 a month for a nice apartment. Well, you raise it 6%, and they may move rather than pay an extra $60 a month because they're signing that lease. That's $720 a year. But if they're in a self-storage facility for $100 a month and you raise it by 6%, they're probably not going to take a Saturday, rent a U-Haul, get their friends out to move on the street to save $6 a month, especially when they're only on a month-to-month contract anyway. So there's this high switching cost and this pain of switching. And there's also this perception that they're going to stay a long time. A short time. I'm only going to need this for 3 months. Yeah, then they're still there 3 years later. And sometimes people are there for 10 years paying for, way, way more in rent than the stuff's worth every year. But they keep it there. They don't have time. And so it's also fragmented. This is the thing I love most. A lot of mom and pop sellers. There's 54 self-storage facilities in the U.S. are owned and operated by individual owner operators. And they either don't have the resources or the desire or the knowledge to upgrade and make it into all that it could be. By acquiring one of these assets and making it all it could be worth 20 to 50% more in a year. Well, that means if you have leverage, you could just double your equity or even triple it or even better in a year. Devin, you might have read the report that came out today. We invested in a self-storage facility in Texas, and we just got a 5.8x return on it in 18 months. And so that's a 480% profit on the equity. And that was because we bought it from a mom and pop, and our operator was a pro. He knew exactly what to do to get it up from 2.4 million acquisition price to a 4.6 million sale price in 18 months. Well, because of leverage, the equity in that actually went up a lot, because he bought it for cash for 2.4. He quickly got it up to worth a value over 4 million. He put 2 million in debt on it. We only had 2.4 million in it. So he put 2 million in debt once it was worth 4 million. And then he got up to 4.6 million value. And that was that 400,000 in equity now turned into 6 million in. So it's the size of huge. I mean, the number of facilities are equal to all the Subways, McDonald's, and Starbucks combined. It seems like it's really easy to manage, but it's not. It's easy to manage a mediocre facility, but it's really hard to manage a great world-class facility. A powerful business plan is to buy from a mom and pop and sell to an institutional buyer. It's actually simple to reconfigure units. I mean, if you need more 5x5s and you've got a whole bunch of 5x10s, you just put a wall in. It's only sheet metal, rivets, and concrete. It's much easier to reconfigure than it is apartments. There's significant ancillary income like selling locks, boxes, tape, scissors, U-Haul rentals, selling insurance, charging late fees, all those things. You want to be in a place where there's a prohibitive cost of land for new competitors, low cost value adds, and there's other things we like are it's easier to evict. During COVID, it was hard to evict an apartment tenant that wouldn't pay, but it was much easier to evict someone's self-storage. They're collateralized. Their rent is collateralized by their stuff, and I love that. I'm going to move a little bit faster here. So REITs, self-storage, from 1994 to 2017, they performed much better than other REITs. And one thing, again, is capitalizing on the mom and pop opportunity that we love. I mean, mom and pop facilities, they typically don't have any online marketing. I talked to a lady near Raleigh, and she said, why would I need any online marketing? Why would I need a website or that Facebook, MySpace thing, whatever? She said, I mean, everybody comes and hands me a check every month. I'm full. And I said, well, maybe you could charge market rent. I mean, maybe if you wanted to get, more profit, you could have an online presence and have, a waiting list. I don't need that. Okay, good. So acquiring a facility like that is an opportunity to upgrade it and significantly increase, whether it's self-storage or mobile home parks or apartments, adding that value to it is the key. The problem with multifamily, and that's the one on the right here, is their multi-apartment owners make up 93% of the universe of 50 and up unit apartments. So 50 plus apartments, 50 unit plus, 93% are owned by companies who have typically wrung the value out already. But in self-storage on the left, only 24% are large operators, 76% are independent operators, and about 50 of the 76% are mom and pop, single operators, where, they can be acquired and upgraded. Mobile home parks, even better, 90%, according to Frank and Dave at Mobile Home University, 90% of the 44,000 mobile home parks are owned by mom and pops. So one of the value plays is to come in, fix them up, rent them out, make them beautiful, and then sell in a portfolio. It's widely known that single property sales might add up to X, but a portfolio with the portfolio premium might be times, like 4x. Or you might be able to get 40% more. That's on the high side, maybe 20% more for a portfolio. If you put them all together, there are similar locations, similar branding, similar management team, etc. And so those are things we love about self-storage and mobile home parks. I also love mobile home parks, and some of the reasons, I'll go through this much quicker: recession resistant, they're steady in all cycles. Ken McElroy, who's a huge apartment guy, said today that he put out a video saying he loves mobile home parks. Blackstone's investing in mobile home parks. The world's, or at least America's, most successful real estate investor, Sam Zell, is the largest mobile home park investor in America with 158,000 mobile home park pads. It's the only asset I know that has a shrinking supply and an increasing demand every year. And so that makes it unique. It's shrinking because people aren't truly not building more mobile home parks. I mean, I've heard Frank Rolfe believes there's only 10 being built in America every year, but there's about 100 being torn down or going out of business every year. And so it's a shrinking asset class, but there truly is an affordable housing crisis. 10,000 people a day turn 65, and yet 6 out of 10 have less than $10,000 saved for retirement. How could that be? But a lot of them have home equity, and they're willing to trade it in for a mobile home park lifestyle. There's high switching costs. It's hard to leave, 93%. Sounds like an unofficial poll to me, but I've heard 93% of mobile homes never leave the original location where someone lived in it. And so people don't want to spend, people who are paying $300 a month in lot rent, they're not likely to spend $5,000 or $6,000 to move that mobile home down the street or across the town to save $30 a month in lot rent. The ownership's very fragmented, as I mentioned. Very low maintenance and capital expenses as long as you're leasing the land and not the mobile homes themselves, which is how most park operators like to do it. And there's a stigma of mobile homes. What kind of stigma is there? Well, we'll talk about that later. So comparing, this is a really confusing graph, but it's really powerful if you can get it. So on the left, there's the bar graph. There is the average monthly rent. And even if you don't get the details of this, the gist of it's pretty powerful. So the average monthly rent is the bars. You want to be as low as you can on the bars. Well, manufactured housing, you can see that the bar is there at an average of $500 a month. And that would be lot rent, which averages, I've heard $325 nationally today, and then plus the cost of whatever mortgage or whatever you have to pay for the mobile home itself. $500 a month. The star is representing the square footage, which is tied to the y-axis on the right. Well, the square footage of a mobile home, the average mobile home, is higher than the average apartment, yet the lot rent's much less than the rent, is much less than the apartment rent, which is less than the average single family home, which is far more in expense than the average mobile home park rent. But the size is the highest of the three. However, relative to the cost, it's not as good a deal for a lot of people. And if there's an affordable housing crisis, a lot of people are going to gravitate to the middle or the left of this graph. Mobile home lot rent in my state, our state of Virginia, is almost 3 times, it's almost 1/3 of a 2-bedroom apartment. So a 3-bedroom mobile home costs a little over 1/3 of an average 2-bedroom apartment in our state of Virginia. It's even more extreme in places like Connecticut. So I mentioned earlier the capital expenses of mobile home parks are low. This graph shows it is the lowest of all these, even less than parking. It's pretty cool. Well, and way less than multifamily. Now, this is all predictable, and if you budget it in, that's fine, but it's kind of nice to know that it is low. Now, I mentioned a trailer park stigma. When I thought of investing in mobile homes originally, I was thinking about the place I grew up in on the left. that's a joke. But seriously, I used to go to a lake called Rocky Fork Lake in Ohio, and we stayed in a place that looks really similar to the one on the left, except for the chairs out front and the junk and the bike and all that. But seriously, it's kind of ugly. And that's what I thought of, but I didn't think of what's on the right there. My friend's father retired as a pretty well-known, accomplished doctor out in California. He actually went golfing with Gerald Ford, and I mean, he was really involved in the Alcoholics Anonymous, and he lectured all over the place. Well, he retired to a place like the one on the right, a mobile home park that was very, very nice. And that's what a lot of, mobile home park operators are striving for now, to take, make their place a really nice place, give people a quality of living, and of course, make a lot of profit for their investors. Mobile home parks, also known as manufactured housing communities, that's why it says MHC, and self-storage have had the highest net operating income growth of all these asset types from 2000 to 2015. And this is another chart showing that manufactured housing is by far the highest expected buy and hold return. Healthcare and self-storage are tied for second place. This is a self-storage facility we invested in it's in Aurora near Denver, Colorado. This is a manufactured housing community in, I believe it's Lancaster, Ohio. That's how they pronounce it there, south of Columbus. This is the one in Gillette, Wyoming I mentioned. This is one in Austin, Texas, we invested in. We don't operate any of these, but we did invest in these. Before I end, I want to talk about having a big why. And I want to talk briefly about why it's really important to have a big why. As I talk about the end of my journey in investing, or at least, where I'm at now, I really think it's really, really important to have a big why. I woke up on October 7th, 1997, and I had about $1.8 million in my bank account that I didn't have the day before as a almost 34-year-old. And I didn't feel any better. I mean, I was happy to have it, really happy we sold our company to a publicly traded firm. I didn't know I was going to waste a lot of that chasing shiny objects, as I mentioned at the early part of the podcast, but at the early part of the webinar, but I didn't feel any different. And if I would have let myself, I could have become really depressed if I didn't have a big why. A big why means something we want to chase, something that's more important than just making profits. This is a couple, Ryan Smith, you mentioned him earlier, Chase. Ryan took this picture. He was in Texarkana, and this was these three kids. I say a couple. This was a single mom and her three kids, and she was in the office that day of Ryan's Park, and she said, and she was really excitedly telling her kids, hey, we're going to buy a house today. They were so excited because they had rented for years, but now they were buying the house they had been renting and moving. They weren't moving. They were actually going to own it. Well, because of this lady might not have to work 2 or 3 jobs now. She might be there for her kids in the evening because of the low rent, the low cost of a mobile home park, because it's a nice, safe place. Hopefully the drug dealers have been driven out. I'm talking about the mobile home parks in general, not Ryan's. Hopefully it's a safe place to live. Hopefully it's a great place for the kids to go down and swing on the swings. It's really important that, these kids are going to remember that, what some people would call a metal box that spits out cash. Those kids are going to remember that as their childhood home. They might be driving their kids or grandkids by that spot saying, this is where I grew up. Well, I want to be part of making something really, really great and wonderful for them. I want to be part of doing something good for them and our investors and my family. And so that's really important. One of the things that I think is, as far as a big why, that I'm going to recommend to you all, there's so many good big whys to have. I'm going to recommend you consider human trafficking, not doing it, of course, but fighting it. Did you know if you took the record profits, not the average, the record profits from Apple, General Motors, Nike, and Starbucks as of 2016, and you added their record profits together, you double that number, that's the approximate revenues generated by human trafficking every year. It's stunning. And I'd like to believe that if I was alive in the 1800s, I would have been an abolitionist fighting against slavery. And I'd like to believe if I was an adult in the 1960s, I would have been fighting for civil rights. Well, this is a civil right, and this is slavery. And it's happening right under our noses, right in modern times. And so when I heard about how bad this was and how awful, what it was doing to the world, I got very upset. And then I went and researched it more. And I found out, in addition to those stats, and this is the one that's mind-boggling, maybe even more mind-boggling than the last one, these traffickers can make up to $500,000 in revenue from one child or one girl per year.
Oh my gosh.
I know that I have a family member who had a very serious crime committed against her. You can guess. And there was a one-time thing. She's still scarred 18 years later, and she's still in counseling. And I can't imagine what happens to these people every day of their life. And so I would recommend, if you haven't got a big why or something you're passionate about, consider human trafficking as something that's worth fighting on our watch. It's worth getting involved in. If you want to learn more, you can go to Exodus Cry. That's EXODUSCRY, Exodus Cry. I think their website's exoduscry.com, or it could be .org, or both. But I met with Exodus Cry staff twice, and I can tell you they're great people, and I really recommend what they're doing. There's other human trafficking organizations that are fighting human trafficking, including IJM, and another one I really like that has a ranch that rescues women and children. They don't rescue them, but they bring them there after they're rescued, and they help them get a life again. And so that's some of the things that I just really wanted to leave you with. I would love to go to some time of Q&A now, and do anything else that you would like to do from here out.
Perfect. Well, Mateus, should we just go ahead and unmute everybody? That way, if they have a question, they can speak directly to Paul. And also, everyone, Mateus has put that website, Exodus Cry, in the chat so that you can click that link there.
Thanks.
In case you're curious or have any questions. But we're going to start unmuting everybody, so that way, if you have any questions, just feel free to run them by Paul. And while we're doing that, I'll hop into a couple of quick questions. If you're already in commercial, Paul, and you're looking to, let's say you're in the multifamily space and you wanted to get into the self-storage space, is that something that you would just recommend somebody can basically go ahead and jump in on, or is there anything that you would point them towards doing first prior to buying their first deal?
Yeah, great question. What I did is I went to Scott Meyer's Self-Storage Academy. It was in Indianapolis, Indiana. He does a lot of those in Indianapolis, and sometimes he does them online now. And I would highly recommend that you jump in by taking that. I think, I don't want to put anybody here on the spot, but I think one of you has done that. And if you want to speak up and tell us, that would be great. But yeah, I would recommend that you get all his materials, his online course, and go through that. There's also a few books out there. They're not super well written, but there's some resources. There's also a Self-Storage Institute. I think it's called SSI. Either they or somebody else like them have training videos you can watch online as well. I think that would be a good start before you take your first jump in.
Okay, perfect.
Hey, Paul, when's your latest book coming out?
The book on self-storage was supposed to
Yes.
come out in June, and then it was supposed to come out in October. And now I just heard they want me to make some revisions to it, and it's going to come out in the spring. So if anybody would like a free advance copy of that, just email info @wellingscapital.com. And that book's been done for almost a year. And I'm welcome. I'd be happy to share it with you if you just keep it confidential.
Thank you.
Yeah, that'd be great. While I wait for some other people to speak up, I'll ask another question, I guess. For mobile home parks, I know some other operators in the space, they're noting how much institutional capital is coming into it with, I believe it was over 1 billion for the past 2 quarters. They've been invested in the space. What are your thoughts on the industry, especially when it comes to a lot of smaller parks? For example, people who are looking to get into the space or just buy a couple of deals to get financial freedom. They're probably going to be looking at parks that are, 50, 70 spaces or less. What are your thoughts on that whole part of the market? Do you think that's overheated, or is that window closing of opportunity closing for that type of size park?
Yeah, there's going to come a day when it's closed. Right now, I think it's still open. I met with a guy the last week in January in Atlanta, and he was musing with the idea of mobile home parks.
Mm-hmm.
I just talked to him today, and he's got 5. And
Wow.
he didn't know anything about mobile home parks in January. I don't know if he's doing a great job running them or not. I assume he is. He's one of our investors. And I talked to him, and I think his parks are 20, 25, 50, spaces. One of them has like 25 spaces on 4 acres, but they have 56 acres that comes with it that they can, put RVs or mobile homes on. I mentioned earlier, people aren't building them anymore, but sometimes if you have one that's already approved, you can add to it. And that's a really good thing to do. I think you can still pay, quote unquote, top dollar to a lot of these mom and pop operators. In other words, you'll pay them more than they ever dreamed they could make, but still be a really good deal for you because they're so fragmented. We invested in the one Devon's investing with us in one in Louisville, Kentucky, 7.1 million. That was 3.5 debt and about 3.6 million in equity, I think, in February. And it's already got an appraisal on it for 15 million. And now that's a big one. But look, that was a mom and pop run large park. It was 311 units. And we've actually got an offer on it, accepted offer for 15 million.
Wow.
That's going to, think about that. The 3.5 million in equity on that is going to go to 11 million, if I'm not mistaken.
Yeah, that's huge.
Yeah. So I think the window's going to close. I think there's an incredible opportunity to amass a portfolio of mid-size, I wouldn't say small, mid-size parks, portfolio them together and then sell them to an institutional buyer like Blackstone or Sam Zell or maybe dozens of others who are going to enter the space.
How big of a size do you think they would need to be? And then how long of a window do you think people have to do that? Probably a few more years.
Well, with 40,000 mom and pop owned parks, it's going to take a lot of years. Maybe 5 or 10 years, maybe before those are all going to get, or many of those are going to get acquired and improved. I've heard, and I'd like to hear what you've heard, Chase.
Mm-hmm.
I've heard 100 lots and up is the mobile home park size that institutionals will look at. As we all know from what happened in apartments, over time, that number will, drop. In other words, it might have been 200 lots and larger when Sam Zell got into this years ago, but now it's 100. Maybe it'll be 50 someday. I
think it's right now for the bigger institutional buyers is definitely still the 100, but a lot of the smaller syndicators and everything, they're looking at a minimum of 50 now. So
okay.
it's got to be at least 50 and up. Everyone that I know that's doing it, it's little smaller firms, maybe just one or two partners sort of thing. They're doing 50 and up.
Okay. Gotcha.
But anyone else have any questions for Paul while he's on the line?
Hey, Paul, Kevin Schiffel here. So COVID eventually will be over with, but I think all humans have been trained to do business a different way, like we're doing right now. What do you feel the impacts are on real estate, and maybe not just self-storage and mobile home, or maybe there is no impact on those two realms, but what do you think you're going to see in the future because of the way we do business now? We've gotten used to this. We've forced ourselves into the future.
Good question. I think that it's going to accelerate, or it's already accelerating the trends that were already there. Online shopping, obviously, Amazon, they just went nuts, and they're so much better than they were. Retail is, the demise of retail. There were 9,500 retail establishments that went out of business in 2019 in America's strongest economy in history. Almost 10,000 went out of business. Well, they say with COVID, not only are 10,000-ish more going out of business, but it's 24,000 this year predicted to go out of business. And so I think the retail demise is, just continuing to accelerate. Office space unexpectedly took a horrible turn. I mean, I know a guy in DC area who's managing $2 billion a year in office space for his company. And he said that they're canceling the contracts on most of those because people realized they could work from home. We've all heard this. We all do it, I'm guessing. And so as far as self-storage and manufactured housing, hard to say. I mean, Green Street Advisors, who's one of the top advisory firms for commercial real estate, they say that self-storage and mobile home parks are going to be the two big winners during COVID. I don't think this is all over, though. I mean, they're going to keep printing money no matter who wins the election here. And I think they're going to keep, I think that COVID is going to continue to be a reality for a while. And I wonder if they're not going to keep doing the stimulus for individuals and small businesses, if there's going to be a real shock. I can't believe how well the economy's doing with the shocks we've seen in the last 8 months. Who could have guessed that you'd have a 20 or 30% shrinkage in GDP, gross domestic product, and you'd still be having home prices and sales at a record pace? How's that happening? Well, I think it's obviously partly government stimulus. I don't think that can go on forever. I don't know. I think there's going to be another shoe drop here.
Yeah, good. Thank you.
Yeah, you bet, Kevin.
What are your thoughts with that impact on the residential and commercial space? Do you see that having any price adjustments on, let's say, self-storage, mobile home parks, and single family, or you think that's going to still stay relatively flat, maybe just slow down in sales pace?
Well, I mean, when I drive down Main Street and I see all these businesses closing, restaurants, there's a restaurant here in Roanoke that's been here for many, many, many decades, maybe better part of 100 years. They're closing permanently. And there's a lot of places, from yoga studios to restaurants to catering businesses to my friend's event planning business, who are closing permanently. How's that not going to have an impact on single family homes? It feels to me like it's eventually got to. I don't see how it could not. And so self-storage, people are continuing to downsize and do the 4Ds. Unless self-storage keeps getting overbuilt as the pace it has in certain areas, I'll talk about that in a minute, I think it's going to do great. Now, I will tell you, in certain areas like Bradenton, Florida, where we have investments, Greenville, South Carolina, where we have investments, Nashville, Tennessee, where thankfully we don't, those are overbuilt markets. There's way too much self-storage. And when a big REIT comes in down the street from you and they can afford to undercut you on price, it's bad news for your storage facility. You know, it's sort of a commodity at that point. And so that's why we love investing in small towns and places where, you know, there's not a likelihood of a big player coming in and undercutting your price.
So, Paul, would you be like, for example, consider like a Danville where, you know, if you look on its economics, it's not something that would really jump out to you. Is that something that is more appealing for you, you're saying, for self-storage or mobile home parks to be a county like that, since it's unlikely that a REIT would be competing with you?
Yeah, absolutely. So that one deal I mentioned that went from 2.4 to 4.6 million, it was not in downtown Dallas. In fact, it was in a town called Beeville, Texas. I've never heard of Beeville, Texas until we invested in that. Some of the other locations we've invested are Grand Junction, Colorado. Of course, there's other ones like Aurora, which is a suburb of Denver too. But we love investing in small towns. There's a certain self-storage company called Red Dot Storage, and that's all they do. They invest in really small towns. The cool thing is the economics work. Unlike multifamily, which sometimes doesn't work in small towns, self-storage theoretically works anywhere you have enough population to support a facility.
Sounds.
Any other questions? Got plenty of time. What we can do too, Paul, I mean, there might be questions that pop up for people is, if you wouldn't mind, we could share the market report, kind of go over that. And
yeah, I'd love that.
Oh, sure. Yeah.
And in the meantime, if there's any questions, just feel free to unmute yourself. And
all right.
You kind of alluded to it already.
What's that?
It's still going strong. It's
Hold on one second. Alrighty. Here we go. All right. So I'll turn this over to you, Mateus.
Yeah. So we saw a 9% increase over the median sales price from October of 2019 to 2020. We're actually at a 10% increase of the median sales price from year-to-date sales from this time in 2019 to now. Inventory levels is actually a little bit higher than last month, but it's still down 39% compared to 2019. Median days in the market, 7 days. The number of house sales in October was 149. That jumped 34% when you compare it to October 2019. So that actually puts us at a 7% higher sales from January to October in this year compared to last year. So I think last month or the month before September, we were at 2% above, and we had just crossed over because we were at a lull and then everything caught up with a strong later season. I think I mentioned before, we're at 10% above where we were at in 2019 with 242,600 as the median sales price. And overall, the year-to-date median days on the market is 10. And that's 41% faster than in 2019. So still a seller's market. Low interest rates are driving a lot of the buyers. And yeah, there seems to be a lot of confidence still, a lot of movement in the upper end of the market as well.
Sorry, go ahead, Kevin.
Oh, thanks. Who are the buyers? Out-of-towners or people looking to upgrade?
There's a lot. I mean, I think kind of all over the place. There are some out-of-towners. Actually, Massanutton's market kind of blew up recently, and that's a short-term rental. I think I had speculation of people coming from Northern Virginia wanting a second home, in case they could just continue to work from home or whatever. They could come to Massanutten and live for longer periods of time and work. So it's kind of both, but Massanutten seems to be a lot more the out of town buyer.
Huh. Any new word from city or county, I guess, governing bodies regarding restrictions on Airbnbs and short-term rentals?
My understanding is that you can apply, and basically, as long as not a lot of people show up in the town, that you can get it. I think last I heard, there's only like a couple that were turned down, and the majority of them were getting passed by the city to have Airbnbs.
Gotcha.
I don't think there's many restrictions in the county as it stands. Maybe some of the towns do.
So are you seeing it? Are you thinking that November, I mean, we're halfway through November now, but November and December, are we going to see a slowdown like we normally do? What are you experiencing over there in Harrisonburg?
My feel, just from being in it, is that yes, it's slowing down. And this month, October, made sense. The number of sales just from the way it felt being in it. But I do think it's starting to slow a little bit more now. I think people are kind of, it's kind of going to the natural course. And I think we'll still end up, 7% above previous years, or at least it might be a stronger, November and December overall than 2019 or other years.
Hey, Mateus, Kevin again. Hey, what's that price point where the upper end buyer doesn't want to put the money into an existing house? They'd rather just build their own forever house.
Oh man, that's
eventually that's in that upper end side.
That's a tough question, because right now the cost of building is so high. So I think I heard recently that's kind of normalizing a little bit more. I don't know if we got past the hurricane wave, but it's still tough. So I don't know. I think there's a lot of people, and honestly, I don't work with a ton of people that are building, but I'm getting activity. I'm showing, $1.4 million house tomorrow, and there's still activity out there in the upper end.
Gotcha.
We were talking about the market kind of slowing down with the way COVID and everything is, and it seemed like it's overheated a little bit. But I think, this is just my personal opinion, but I think one thing that's going to help Harrisonburg and Page County here is I've noticed a lot more people that are coming in that are out of town looking for a second home, trying to get away from the city. So I think as that urban sprawl expands, it's going to help shield us from downturns. That's just my thought. I mean, we might still experience it, but it probably wouldn't be as severe as other areas, would be my impression.
Hey, not to monopolize the time, but just a side note for everybody listening. My carpenter is a GC also. He said that the warehouse just sent him another letter saying to expect an 8% uptick in material prices at some date within the next 30 days or so.
Oh, wow.
I mean, your average 2x4 right now is, I think, 3 to 4 times the normal price. So that tells you anything about building costs.
Okay.
Yeah.
My son buys and sells land, large chunks of land. If anybody knows any land out in the sticks, out in Rockbridge County or anywhere else out there, let me know. But he said that the timber prices have gone through the roof.
It's probably great for him, right?
Yeah, it really is. Right now, he's a little nervous about what's happening, like what's going to happen in the next few months. But right now, yeah.
How much land does he need?
He buys chunks anywhere from 50. I mean, he could buy under 50 acres, but he really likes to buy 50 up to 500.
Okay.
He's got like 12 to 1400 acres right now that he has, that he's holding, but he's sold some as well.
Okay. Gotcha. That makes it trickier with that much acreage. You don't see a whole lot of that.
Yeah.
All right. Well, any further questions about the market report or just, general questions for Paul? We got him here. All right, hearing none, I'm just going to move on, just really quick, wrap it up with announcements. So we're not going to have one in December because of the season and the holidays. So our next meetup is going to be on the third Wednesday, as always, of the month in January on 2021. And we may be having a guest speaker discussing how to raise money and invest out of state again. So this individual has put together a property management company and is investing. He lives in Virginia, is investing in Tennessee and raises private capital to do so. So that's who we're potentially looking at having come in January. And he's also going to discuss creative financing a little bit there, but that's pretty much it. I want to thank everybody for coming out, and thank you, Paul, for taking your time to speak with everybody. It's been great. That was a really great presentation.
Thanks. It was a real honor to be here, and I really appreciate the opportunity, and glad to see all of you.
Yeah, it was good to see you too. Look a little bit different with a beard.
Thank you very much.
Well, we can show you this recording afterwards too, so you can use that. And if anyone has any other questions or is curious about the websites that Paul had talked about, just reach out to us and we can send that to you as well. And with that, wish all of you a good night.
All right. Thanks, everybody.